Good evening, ladies and gentlemen. Welcome to NNN Media. I am Dr. NIK NIKAM, and all our programs are video streamed through YouTube channel NIK NIKAM, where we have more than 7,500 subscribers and 2.4 million views. We have more than 1,100 videos. Please do subscribe to our YouTube channel, and we also have a Facebook page, which is NANO News Network or NNN Media, where we bring you the latest news, views and opinions from around the world. The biggest news of the year 2017, of course, is this. I should say this is the biggest news for the century.
Yes, I would say so, Dr. Sir.
And exactly. We are going to be talking about the latest tax bill, and my special guest is Swapan Dhairyawan. Did I get this right?
You got it right?
Okay.
Finally.
Okay, delighted to have you. And we are going to be talking about one of the greatest tax bills passed in the past 100 years. That's what I hear from the news channels. And we will find out, or try to decipher and understand what this particular tax bill means to you and me. That is the most important thing. It doesn't matter what happens to other people. So please do subscribe to our YouTube channel. We're going to start off. Swapan, just give us a little bit about your introduction, and then we'll dive right into the taxes.
Sure, Dr. Sir. And great to be here in the studio with you. And I remember when you reached the 1 million mark, and I hear it now is 2.5 million. So that's great. You are doing great for our Houston community.
Thank you.
And I'm Swapan Dhairyawan, and I'm CPA licensed in Texas. I have been doing my practice for almost 14 years and over. I'm from Mumbai, India. I moved from there, did my CPA over here, and have my practice over here in Southwest Houston at 59 and Gessner. And it's a full-fledged staff. We have about 11 people. Give us your phone number
in case somebody wants to have more questions after this interview.
Sure. Our number is 713-774-6533 in Houston, Texas. You can reach out to any of our staff specialists. It's a mid-sized firm with about 10 or 11 employees up over here with us.
Yeah.
And we are doing mainly businesses, small businesses, medium-sized businesses, local businesses, which is community businesses.
Yes.
And we are dealing in corporates as well as individuals.
Okay. Ladies and gentlemen, we are going to be talking about the new tax bill that was just passed by the House and the Senate. And this is maybe one of the greatest accomplishments of President Trump. And so let's dive right into this. Just give us a synopsis of what this new tax bill means to different levels of businesses and individuals.
Okay. Sure. Now this tax bill, which is actually a Christmas gift, I would say, a bundle of joy for some, and it came up on December the 20th.
I know.
And it's technically, it is the Tax Cuts and Jobs Act 2017. It's a 500-page document, Dr. Sir, and the Treasury is going to write the regulations out.
I see.
It starts for the year 2018, so the first applicability when we file the tax returns of 2019 is when all these things come up in place.
Oh, so in other words, whatever the deductions or the benefit we're going to get is going to be for the year 2018. So it's not retroactive. So you're not going to get anything for 2017.
No. But there is tax planning for that, basically, which people were doing, basically. And we'll talk about that when we get with some more questions down over there. So as I mentioned to you, this is going to be a major reform, and this is a major reform. To tell you, the IRS, the Internal Revenue Service, was formed in 1862 by Mr. Lincoln in his presidency. So it's been around for I would say more than 150 plus years. And it's doing a terrific job, I would say. You might call me a pro. But the thing is, it is doing a lot of service and it is doing a lot of compliance.
If you look at it, if you look at all the European countries and Far East and all this, the tax rates are just astronomical. We already had probably the best tax rate, especially for businesses and individuals compared to most of Europe.
Exactly. And at some point of time, even in the United States, the tax rates used to be close to 70%.
70%. I remember the days.
Yes, and you must be the older one because I'm in this country for the last 20 years, just about. But I don't know, I have not seen that. But the ones which has happened, this reform which has happened, since 1986, they talk it to be a reform after the Reagan era, because that was the time that a lot of things got revamped. And it's very, very critical, and I would say it's very, very dynamic, I would say. It gives us a lot of areas to think and plan, because it has been around for so many years, because we thought that, okay, it's taken and it's given for kind of a thing. So this is something which is going to put a lot of tax practitioners into play to think about it.
I thought you were going to say out of business.
No, not really, not really. That was one of the thought process by the presidency when they said that, okay, this is going to happen and there's going to be a postcard kind of a thing, and HNR block stocks dived. And that has come up now back because it's not really.
Let's talk about, they cut the tax rate from 7 brackets to 3 or 5 brackets, whatever it is. Let's take average middle class family with $100,000 joint income. And what benefit are they going to get? Let's start off with that and look at different groups.
Sure. There would be a whole lot of things, because what's happened is for the individuals, the highest, which was at 39.6%, that's going to fall tremendously down to 37% in the final bill which has happened. The levels of taxation are still going to be the 7 slabs across over there at 10, 12, 15 and all those things. And everything is on the Google, you know that. Everyone is already researching about it. But what's going to happen is the corporate side is something which is more dynamic, and that is where the money is going to come in, is what has been forecasted, because the corporate rates,
what the Democrats
don't believe.
The problem is about. Okay, we'll get into that. Okay.
So as I mentioned to you about the 100,000 thing, I just ran a quick number, a logistic based on a 2017 tax return for a particular case law of my particular client, who was making a W-2 salary of $111,000 and an interest income of $900. Based on that, he was taking his itemized deductions for his home, his property taxes, and the sales taxes, which is allowed. And based on that, he had a family size of husband and wife and 2 kids. So at that point of time, including his child tax credit, what he was paying was $7,900. Same scenario, we ran it for 2018 with the same salary, with the same interest income, the standard deduction, because what's going to happen eventually, the new change, there are not going to be any personal exemptions. Okay, the standard deduction is going to be 24,000 max for the married filing jointly,
even with the kids.
Yes, even with the kids. But
that's number 0.1 ding.
Yes, correct. So with that being said, even if that scenario is run, hypothetically, when I ran that number at that level, because he is getting the child tax credit of $2,000, which is enhanced per child, he is saving close to $535.
My gosh, $500. That's like a huge bonus where you can go to McDonald's and get a nice dinner for a family of 4.
Yes.
No, seriously, this is where I find this tax bill to be totally not reaching out to the middle class. And I was looking at it, for physicians, an average salary of $200,000.
Yes.
Basically, you do get these personal deductions and all this. But now they've taken away a whole lot of things, itemized deductions, they've taken away property taxes and all these things which we'll get into. At the end of the day, it doesn't make any difference. I may end up paying more taxes and less deductions whatsoever.
That might be the case on a scenario to scenario basis. What they have done basically is they have capped on a particular things. 2 things which they have capped is your property taxes. It's $10,000 flat. No matter what, if you have $1 million house, if you are paying $30,000 in property taxes, in spite of that, you will be capped at $10,000.
This is daytime robbery, I'll tell you.
Okay.
If you work hard and you have a house in River Oaks or somewhere else, and you're paying $50,000 property taxes, now you're paying tax on the remaining $40,000, $50,000, whatever it is.
You are not getting any deduction for that.
No deductions. So basically, you are cutting off all the incentives for people
buying new homes
to invest in their house. So how is this going to affect the real estate market?
that is for someone to see. And because what's going to happen is real estate market, they are targeting more likely for reasonable houses. And that's what they have capped. The $1 million interest indebtedness, which used to happen, they have stepped it down to $750,000. So your interest on your mortgage, if you have a house which you bought it after December 15th, you will not get dollar-to-dollar deduction on the interest if it is $1 million house or anything more than 750. If it is less than 750, dollar-to-dollar, you can get the interest deduction.
So there you're hitting me again.
Again, of course.
Property taxes, now, you wiped out after $10,000. Now the interest payment.
Yeah.
So
they are telling you to be more charitable. There is no cap on that. Give to charities.
Just don't give it to IRS everything. Ladies and gentlemen, you are watching Triple N Media. I am Dr. NIK NIKAM, and we are talking about the new tax bill. And every time Swapan is making a statement, I am having second thoughts, but we will find out a lot more about this tax bill. And please do subscribe to our YouTube channel, which is NIK NIKAM, where we have more than 1,100 videos accenting our experience here in the United States, and more than 7,500 subscribers. The last time you were here, we had only 1,000 subscribers.
I remember that.
Yeah. And we also have a NANO News Facebook page where you bring you the latest news, views, and opinions from around the world. So let's move on now. The corporate rates are down to 21%.
Yeah.
How can you justify bringing a corporate rate from 35 to 21%, whereas middle-class American family making $200,000 to $500,000, their tax rate went down maybe 1 or 2%. I know you didn't make the law.
I did not make the law. The trickle-down effect is what they are talking about.
That's not going to happen. I'll explain to you.
So the thing is, what's going to happen is, for the large corporations, which are C Corp, because everyone knows the entity structuring is something which is going to come to play in the next year when we get started, when the Treasury starts writing the rules. Because C Corp, which was supposed to be something of way in the back burner, is going to come up in play now in the future. Earlier, S corporations, LLCs, pass-through entities became the light of the day. Since 1990s onwards, those were the ones which were in the business, and any CPA, any attorney that you go to, have LLC, be it pass-through, don't pay double taxes, and
pass on.
Yeah, so that is what used to happen. But that something is going to change, and we are going to look at the rules. How the Treasury is going to write that, because they have capped that. There is something into the pass-through entity in the sense that they are taxing the pass-through entities at the individual level with a particular tax bracket, kind of. So that is going to be something that we have to look in for. But C Corps, for that matter, as you said, 21% flat, that's going to trickle down is the hypothesis. Which
trickle down. Okay, let's discuss this topic of trickling down.
Yes.
Let's take, for example, Apple or Google or something, assume they have your C corporation. Where their tax rate goes down from 35 to 21%. Do you think the taxpayer or the stock owners are going to get any benefit? And if so, how?
Okay, there are two aspects to this. What they are doing is basically, one is the bringing down of the tax bracket.
Yes.
So that money which is there, the dividends which are there, what is happening is people used to accumulate the earnings. Okay? They did not used to do the payout on the dividends. Because the dividend rate was also kind of a high thing. So now, because of this, paying the 21% and then you give it to the individuals, if their tax brackets are lower or whatever, they can still be better off, kind of a thing. The second thing is, you talked about Google or Facebook or whatever. I just read an article just yesterday. Facebook has already said that they are going to pay taxes locally, in the sense that, remember that Ireland thing and everyone.
Yes, for the
Apple, Facebook,
Microsoft even.
Yes, so they are going to come up that if the goods are sold locally, it will be charged locally. So will that not be a trickle down for the local counties and the cities in which the sales are being originated? Earlier, they used to be shielded because it used to be Ireland.
Yes.
So So one point, and this is, they have already announced it, that they are going to do that. So I think so within a week's time, some people have started doing that. For that matter, let me tell you about Wells Fargo.
Yes.
Wells Fargo has already announced that they are raising their minimum wages from $13.5 to $15.
Sure. They already got 15% net revenue up without doing anything.
Yeah. So let's talk about this. These big companies are there. There is AT&T and Comcast. They have already announced that they are paying 300,000 employees of their $1,000 bonus already before the end of this year. So some trickle down, some money in the economy is going to flow through. Don't you believe that it's going to help the economy?
I don't know. If my taxes are cut from 35 to 21%, I'm not going to give it to you or somebody else. I'm the CEO. I'm going to make sure that I get more pay and more options, stock options and benefits and retirement funds. I am not sure I want to even serve my stockholders. I mean, this is an argument. So
that is an argument. And
exactly. That is exactly me. I have a corporation, but
it would happen because the stocks options, vested shares, compensations of high compensated employees and everything, they do have the vested interest. But overall, you have to see that if this economy has to thrive, if this country has to thrive, you cannot let the people stay in poverty. You cannot have the rates that, okay, if you make only 40 grand or 50 grand, then only you get the benefits. No, you are letting people to stay within this income. Why is that? Make more money, pay taxes of that, and then you have surplus of that.
Yeah, give them more money, they move into the higher tax bracket, so the government benefits.
Exactly.
Okay, you're talking about this 21% tax rate, which is fine.
Yeah.
But there are a lot of things which may not happen as the Republicans want it to happen. Because the Democrats say this is $1 trillion handout to all the big corporations and the big boys for the next election. How do you answer that question?
For that matter, not taking any political sides on that, my thing is, there is a problem in Washington and there is a deficit, and that deficit did not happen overnight. Okay, it has happened during the past two regimes of the past two governments when they were 8 years in force. Okay, it is going to happen in the future too, and it started right since the debt ceiling which they put up in the 1990s for that matter. So the thing is, how do you control this problem? Because you have overspending so much, and revenues are only X amount which are basically from individuals or corporations for that matter. To give you just one statistics of that, close to, I would say, there are 147 million individual taxpayers as per 2014 data. Okay, and there are 2.2 million corporate taxpayers as per 2014 data, and they put in revenues to the IRS close to $2 trillion in revenues. So that is what it is. So based on that data, if your spending is X, you have to have some kind of a debt ceiling. It's not happening no matter what. That is not happening. The spendings are various. So somehow or the other, if you do not cut the taxes, somehow or the other to bring something differently, because you have tried this thing of giving the freebies, keeping the SOPs, giving child tax credit and everything to the low income, to the middle, but it's not working for that matter. If it is not working, try something different. Bring this cash money. And as I mentioned to you, it's not only the dividend that is 21%. They are talking about the money which is not distributed lying in the corporates outside. If you bring in the money, there are two different tax brackets in which you can be bringing that money as dividend and repatriation. So that is something, I think so, I feel so. It will have a big lobby effect for the big compensated employees, but eventually there is still going to be some trickle down to the masses. And I am hopeful about that.
Hello, ladies and gentlemen. Welcome back to Triple N Media. And my special guest is Swapan Dhairyawan. We are talking about Donald Trump's tax bill. This is a tax bill of the century, as they call it. And please do subscribe to our YouTube channel and also visit our Facebook page, NNN Media, where we bring you the latest news, views, and opinions from around the world. We were talking about simplification of tax, and in fact, Donald Trump has mentioned he wants to put a lot of tax business. I don't want to get any names. Tax firms out of business.
Yes, as I mentioned earlier as well, when that statement did happen few months back, HNR block nosedived
Yeah.
But it's nowhere thing which is going to happen. This 500-page legislation which the Congress and the Senate has put through, once the Treasury writes, and the Treasury is going to be very busy, let me tell you, with their short staff in the next tax season, don't expect the whole time to be any time less than an hour if you call up the IRS. Keep that in mind, because they are going to be putting a lot of hours, put the regulations in, because the new forms or new things for 2019 tax, when the 2018 taxes will be filed, will have to be placed, and those draft forms will have to be approved on the IRS and through the software services to the practitioners and all those things. That has got to happen before the summer of next year.
That's true. So because it has to be ready.
Yes.
It has to be ready before the 1st of 2019 for them to put all this tax
stuff.
So
it's not going to be simplified. The postcard thing, that's not going to happen. As I mentioned, the low tax clinics, low income taxpayer clinics, those are going to be still around, which have a simple W-2 and a simple standard deduction, just a couple of kids and all those deductions, and they're done with. That's okay. But it's not going to happen when you have multiple sources of income.
Okay, since you brought up children, so let's talk about the child credit and how the new tax law affects the families.
What has happened in the child tax credit, let me tell you, the bill has proposed actually to increase the limit of per child tax credit of $2,000, okay, instead of the earlier ones which was there, and $1,000 which was there. And plus, they have said that max $1,400 is refundable credit, while $600 has to be towards taxes, of course.
I see,
So that's how they have played with it. And of course, they have increased the threshold. Earlier, it used to phased out at close to 240 or something like that income taxpayers married filing jointly. They didn't used to get it. So now they have increased this taxable income for married taxpayers filing for more than 400K. So if I have a daughter or two daughters or whatever kind of, I am still in that tax bracket. I can still take the 2,000 credit for the child tax credit, which in the earlier regime, we never used to get that.
I see,
So that is one thing. Plus, they have added one more new thing. It is for qualifying dependents who are not qualifying children. So what does that mean? We don't know. When the Treasury writes it, we'll get to know. But $500 credit for even them, they have added it. In addition to the dependents who are children, apart from that, qualifying dependents, they are saying $500 additional child tax credit. So let's wait and see.
Let's talk about healthcare. I mean, obviously, healthcare has been in the back burner of every Republican for the last 8 years, and they just gallantly tried to uproot Obamacare. They couldn't, but now they tagged on something to this tax bill. How is that going to affect the individuals?
Okay, I will take this not the Obamacare about it. Let's talk about that a little bit. It has been around. It has done wonders for some. It has brought in a lot of compliance, because you being a practitioner in the medical field, you know how much paperwork has increased also in that regard. But as regards for us as CPAs, for that matter, a lot of compliance has happened and a lot of paperwork has increased, no matter what, because of Obamacare. So now in this particular bill, what they did was, that particular one clause, because they could not approve Obamacare, they came up with a relief in the section 5000 which was there. The individual mandate which is there, they have taken it off. So what that means is basically, you don't have to pay the penalty if you don't have insurance. And that's a sweet thing, I would say.
So that's for the corporations?
No, that's for individuals.
Individuals.
I have an employee in my office and he makes say 30 grand or 40 grand for that matter. He has to enroll to Obamacare.
I see.
He is paying for the last 3 years since he has been over there. The first year it was $100.
Yeah.
Next year it went to $160. This year he went for enrollment of Obamacare. It is close to $240. His health hasn't changed. His body is single. He attends to the doctors every year, only 1 or 2 times, just the medical and the wellness. But he still has to keep the mandate, which is minimum essential coverage. Okay. If he didn't have that coverage, he was paying that 1%, 2% or 2.5% of income as a penalty.
Penalty. I see.
So they have taken off that penalty clause because now he can not have insurance, but he still doesn't have to pay the penalty. He can still have his insurance through different other schemes in which are not full coverages, which are not minimum essential coverages, but which are still stopgap arrangements. And you know what I'm talking about. Those insurance are there in this country, which offer him premium of close to maybe 1/3 of the cost what he's paying. Just $50 if he pays, he's okay because he just goes 2 times in a year. That's all.
Okay, let's talk about, this tax bill is also a jobs stimulus bill or whatever you want to call it. The unemployment rate this week was 4.1%. So how much more jobs are they going to be creating? What are they talking about jobs when the unemployment rate is 4.1%?
Statistically, in wherever I have read and whatever I have kind of heard about it, that number is not going to change more than 0.6%. Okay, so the fall in the unemployment technically is not going to be more than 0.6%. For that matter, be very optimistic and you can say bring it down by 1%. Okay, we are not talking about that. We are saying that rather than unemployment, putting more money into the pockets of the people is something more important because that is going to drive the money in. That is going to help the businesses run. That is going to keep the brick and mortar stores going.
Is this going to get money from Apple, Google and Microsoft? Billions of dollars. So maybe altogether $500 billion from just these 3 companies which are, collecting dust in foreign countries. Are they going to be forcing them to repatriate that money?
They cannot force them, but yes, it will be a sweet deal for them because these accumulated dividends which they can repatriate, which are, the clause says, if those are dividends post 1986, of course they are after that. And they are bringing it in cash kind of a thing. They are repatriating it. The tax rate is 15.5%. And non-cash, if they are bringing it, it's 8%. So if they do that, remember this entire window of this bill is from 2018 to 2025. So whatever tax planning they have to do, because they don't
then
know,
it's going to go back to the original.
They are going to go back. It's just like the Bush cuts. When 2008 it happened, the Bush cuts, most of them, they got expired, and then suddenly when the capital gains which reached at 0%, it suddenly went up to 15%. Kind of. You know that, how that story happened. So if this bill is going to stay till 2025, that's what they're forecasting. If most of that money comes in, is it not going to be a positive thing for this country in the competitive sphere when we are seeing China already at the GDP, which is already very close and tight-neck with the United States?
In fact, their numbers are much better than the United States. We are like 3.5%. They and India also,
have been running like 7+%. India is almost at 7.2%.
Oh, okay. So when they bring all this money and you say they're going to give it in dividends, so the stockholders are going to be pretty happy. Is the stock market going to explode from this one? It's already exploded.
It's already going up. It's already up. How much more and when the correction, the reality is going to happen, we have to wait and see. But my presumption, my feeling is it will go at a particular point and it has to stabilize at that.
Yeah.
It's not going to bring down to the years in which what happened in 2008 and 9. That scenario is not going to happen, is my feel on this, my take on this. I might be overly ambitious about it or overly optimistic about it. But if this money, most likely than not, is going to come back, is my feeling, because this sweet deal which is there is not going to happen again and again. Because what happens in the Congress or in the Senate or in the White House, all these things being together for the first time, controlled by the Republicans, and of course, so many states already there. So based on that, that's not going to happen in a long time to come, maybe.
Oh, okay, now let's talk about, during every election they talk about college tuition fees and, trying to help the students, parents and all these things, which is just an election pattern, I should say. Does this bill have any positive effect on student loans and things like that?
There is nothing much written onto that. We still have to wait and see. But one thing which has happened over here is they have included something about the 529 plans. What they did was, as you know, 529 plans are for higher education, which is post-graduation kind of. So, if you tap into that resources and tap that money, you were not taxed on that kind of. What they have done is, even if it was supposed to be for their private schooling, in education, in elementary and high school plus, and if you have to tap into the 529 plans, you can still do that. Without paying the penalties on that.
I see.
And even they have added the clause of homeschooling. They can tap into that. So I don't know, people might take a wrong kind of thing into that kind of. I don't know how they are going to work around with that. What compliance would happen into that. We have to look and see what the Treasury writes the regulation. But that is something new that they added, because you know that if you are living in Sugarland, you are putting your kid in a private school.
It's the same as paying for a college.
Exactly. You are paying 10,000 grand a year or 15,000 grand a year. If you can be able to tap into that, because you don't know, eventually your son might be going to New York or California, and then this 529 plan, I don't know how that will work, how much proportion you can get in-state, out-state, all those things do apply. So based on that, even if you were able to take it for him, for his middle school and high schooling, that's an advantage.
See, again, it goes back to helping the rich, like the Democrats say. So you stacked away a lot of money for your children. So not only college, now you can pay for even their elementary school and middle school, private school and all this.
I would say yes and a no. It's not only the middle school. In my practice, I have seen also middle income school, because they are husband and wife. They are engineers, they are doctors, or they might be close to software consultants. They make 300K, 400K, whatever, but they would like their kid to be in a good school and a private school maybe. So they are putting the money in a 529 plan, and if that money is not going to be used, you're going to be taxed eventually. Why not use it when he's going into school, which you know you are going to pay for no matter what? So is it not a good deal?
It's a good deal for the rich people.
Whom do you call rich? Is
$300,000. Ladies and gentlemen, we are listening to Triple N Media. I am Dr. NIK NIKAM, and we are talking about the new Donald Trump tax bill, or tax bill of the century. And what are your final thoughts on this? I know it's going to keep the CPAs busy, I would think. Anytime there's a change in the law, by the time they write this law and then all this new implementation, so nobody will understand, then everybody has to rely on the accountants.
So basically your question is that it is going to keep us busy. Yes. And as regards, be aware that yes, there are going to be practitioners who are going to try to cut corners about that. And in any trade or business, it does happen. But make your good judgment. Be in compliance, because we as a community, we have grown. We have seen the growth and remarkable progress in the community. So let's put that money away if it is for infrastructure. We came for a good country because we want to have good results for our family, our kids.
Sure.
So I always say to anyone who comes to me for consultation, if you say that I'm going to pay zero tax, I'm not the one that you are going to hire. That's what I say. You need to be aware that no matter what, I never made $100, I made $80. Unless until you have that mentality for living in this country, you're paying for the infrastructure, the best of the things which you get out of this country. That is the cost that you're paying. That is my present.
Absolutely. No question about it, because when I looked at my own paycheck, I realized almost 45% of my check, I don't even see it.
Yeah.
Which is perhaps maybe not as bad as it is in European countries where, maybe 70% of the paycheck you may not see.
Yeah.
So this is an exciting topic. And as you said, maybe we are just scraping at the top of the iceberg, and by the time it trickles down. But I still think for the middle class or the people who are making between $200,000 and $400,000, they will eventually end up paying more taxes because because they have taken away all these deductions and itemization and all these things.
You're right about that. And for that matter, this was too early. But yes, we can sit and talk maybe at another day down the line.
Yes.
Because by that time, we'll have more information from the Treasury. Today, I could do this hypothesis because based on just a simple numbers, once I know for a individual, for that matter, who has a business, what it will take if it has multiple things or sources of income, and what is his tax saving based on this pre-2017 and post-2017. If that numbers, I will be running hypothesis and examples, and I am not so very positive about it, but I still see this ratios, there will be some saving, maybe $200, maybe $500, maybe $2,000 in some scenarios, which the bill claims to be. They say that $2,100 is for a taxpayer for $70,000 of income or something like that. It gives an example over there.
Yeah, I saw an example. People making from $200,000 to $500,000, their tax savings is like $2,600 or something like that. That's like a drop in the bucket, because you've taken away all deductions. You put a ceiling on my property taxes. You put a ceiling on my interest rate and everything else. So, this is a sweet deal for the corporations. For sure. And the top executives, perhaps.
Yes. But obviously, if they are the executives, they are going to eventually pay the taxes as well, unless they are going to defer it somehow in some different way. But if it gets deferred, somehow or the other, they have to make a decision if you're deferring it. If they're deferring beyond 2025, you don't know what's going to happen after that. Yeah. So obviously, you have to pay the taxes somehow or the other. Debt and taxes, you cannot miss in this country.
Well, that's a given.
Yes.
Swapan, it's been a pleasure talking to you, and let's get together again a few months from now and figure out how and where we can learn more about the middle class. That's what I'm more interested, because that's what's going to affect each and every one of us.
I will have more hypothesis about that. I can work illustrations about that in my general line of practice and what it would take, because by that time I know the 2017 what the numbers are, what's going to be 2018.
All right. Thank you so much.
Thank you.
Ladies and gentlemen, you have been watching NNN Media. I am Dr. NIK NIKAM, and please do subscribe to our YouTube channel, and also please visit our Facebook page, which is NANO News Network, where we bring you the latest news, views, and opinions from around the world. And have a happy new year and start a fresh year with lower taxes, hopefully.
Happy New Year and happy holidays.
Thank you so much.